All right, testing 1, 2, 3. Hello, folks. How's it going? So, thing number, well, okay, first I want to share my screen, I think. Make another attendee the presenter. Available when there are qualified attendees. Because I want to let Doug talk. Doug's our hedge fund manager for Capital Ideas. And we're finishing the quarter. And we also want to talk about just some general strategy stuff. So I'm going to do that in a minute, but let's let a few people come online first. But let me test with Doug before we do anything else. So let's see, how do I do this with Doug? Copy, send a chat, copy email to clipboard. Doug was telling me he's not sure he has I don't know if he can call in on these webinars, so I'm not sure what happens. But let's find out. Well, actually, I'm going to check with Doug by text to see if he figured it out. Maybe he won't be able to come on. I guess I should check that first. Do you have a way to speak on the phone? It says no mic, he needs to call in. Oh, you can hear me. So can you, so Doug, there's no line to say call in audio via phone or something like that? It says phone call up here. See up here where it says phone call? Oh no, you can't see my screen. That's interesting. Sorry about that, folks. Hey, can anyone hear me? I know Doug could hear me. Can you guys hear me? I went off for a second because I was checking out the phone audio to see if that was something that could be used. So I think Doug's going to try it and see if it does him any good. Checking out the phone audio to see if that was something that could be used.
Hey, Phil. Can you hear me?
Oh, I hear you. How do I hear you? So I think Doug's going to try it.
I'm called in.
Oh, I see. You must be called in as if you're me, the presenter. That's good. All right, now, so guys, can you hear Doug? Doug, say some stuff. The phone audio.
Can anyone hear me? Hey, Phil. Can you hear me?
Oh, I hear you. How do I hear you?
Oh, we're delayed.
Doug's going to try it.
I'm called in.
Oh, I see. You must be called in as if you're me, the presenter. That's good. All right, now, so guys, can you hear Doug? Doug, say some stuff. The phone audio.
Can anyone hear me? Hey, Phil. Can you hear me?
Oh, I hear you. How do I hear you?
Oh, we're delayed. I'm called in.
Oh, I see. You must be called in as if you're me, the presenter. That's good. All right, now, so guys, can you hear Doug? Doug, say some stuff. The phone audio.
Can anyone hear me?
All right, sorry about that. I couldn't figure this out.
How do I hear you? Oh, we're delayed.
hang on, let's figure this out. If I take off my microphone.
Can you hear John? Hello?
Okay, so for Doug's benefit, Doug, when you talk, you're talking on my phone call line apparently. So when I talk, you can't talk, and there's going to be like an echoey thing. So what's going to happen is I have to mute myself. When it's your turn to go, I'll just mute myself, and I'll text you if I have a question or something.
Okay.
Because it won't work if both of us talk. So let me do that, and I'm gonna. Oh, wait. If I turn my speaker way down, that would help too, right? Because I don't need to hear. Oh no, then I need to hear you. I just need to turn it down. So complicated. All right, so let's see. Is that my sound level? Sound check. Nope, got to do that here. All right, so. Oh, it's a function. There we go. Okay, I think that's going to work. All right, guys, so let's start the webinar, and then I'll introduce Doug, and we'll have a chat. All right, so step number one, do this thing, and I'll be right back.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and trading services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, so we're going to attempt to have Doug speak. Doug is the hedge fund manager for Capital Ideas. He does all of our trading and such, and he's my partner in the venture. And we'll talk about some of the stuff we're doing over there, and we'll talk about just trading in this kind of environment. It's been crazy. This choppy, insane sort of thing that we're doing has led to wild swings in the market, and we're trying to keep them under control. It's very challenging when you're trying to trade inside a fund, and of course, you know, the market's all over the place. But we're really just back to that. Let's see if I can pull it up on stock charts. You know, we're really in this sort of choppy, toppy range still. That's a fresh chart. Good. Okay. So, you know, on the whole, here's where we started the year. And no, that's July. Sorry, apologies. Here's where we started the year. It's drastically different right here. This looks nice and calm. Here's where we started the year. And here's where we are now. Basically exactly where we started the year. We've made no progress. We had a wild ride all the way down, all the way up. And we're kind of drifting along around this 3,300 line, which is where we consolidated before. And we'll see what happens at this point. But look at this increase in volume here since the drop. A lot of trading, been much more robust trading And you can't go by this because this is a weekly view. But it's been like that. So basically, we went through this route here. This was a nice steady amount for the highs along this. And 2850 is where we think the S&P should be topping out. That's what we thought was right. Doug can't see my screen. That makes no sense. Did I not share my screen? Oh, that's my bad, guys. Sorry about that. All right, just imagine the visuals. I'm so sorry. I just realized that you couldn't see the screen. All right, sorry about that, guys. So imagine all these fantastic things I just told you being visually presented. Mistake. Then I realized it was down here. So here we are. Now you're all caught up. But technical things I could care less as you. This is important because what happened is we went through. This is a very toppy sort of motion. What the hell? Weakening. What was that? Oh, that was Doug doing something. Okay, sorry.
No, I wasn't saying anything.
Oh, okay. Oh wait, you just talk. Can people hear you when you talk?
I don't know. Can anyone hear me?
Guys, can you hear Doug? Oh, good. They can hear you. So what do you have? You have your side muted? Is that what you're doing? Doug?
I'm not doing. I'm just talking on the phone. I can't.
No,
I'm delayed for some reason. I'm getting a delay from. When I speak, I'll hear myself about 2 minutes later. So I have my speaker on. It's like a radio. So I have my speaker on 0 right now.
Oh, okay, great. That seems to be working. Then you can hear me through your phone, right?
Yeah, exactly.
Oh, that works out okay then. All right, good. But I'm not sure what's going to happen if I try to make them see your screen. Were you planning on showing anything on the screen or just talking?
No, just talking.
Oh, okay. Well, then we're all good. So, Doug, you can see this now, right?
Yeah.
So what is this thing called, this indicator? Do you know? I'm going to put you on the spot.
I don't know where you're pointing to.
Oh, I'm sorry. On stock charts, on this thing on the top that says PPO.
I can't see it for some reason.
You don't see it on my screen?
No, hold on. Let me try something.
How weird. So they can hear you. You can't see the screen.
I mean, I'm guessing it's a percentage price oscillator.
Okay, that sounds good. So
am I right? I mean, I'm not
on the S&P, on the S&P and the gallery view of stock charts. I
mean, I don't know another PPO, so it has to be that one. I'm guessing. Oh, I can see now. I can see your cursor thing.
Okay. Wow. I don't know why it took so long. Anyway, so I was saying that the PPO had been strong since the crash. Basically, it got stronger and stronger and stronger. Now it's failed off, and now it's actually heading negative. And that is going to mean that there's going to be some downward pressure. And at the same time, you have these guys crossing, and that's not a good sign either. So it's the same kind of problem we had over here. Back right before the crash, we had this exact same thing. We had a cross, and at the same time, you have this downturn on this side. And it's kind of tricky to escape having a crash when this happens. See over here also, you have the cross below, and then you have this downswing. So we could be heading into another downturn, which is a downturn we keep expecting that we haven't had yet.
You can see a little downturn right now because the dollar's rising.
And except it's rising again, or because earlier today it was down?
It's rising right now. That's why silver's moving lower.
Oh, I see. Okay. So that's a weekly view of the dollar there. It is actually coming off its bottom at 92 anyway on the longer term chart, but we're still miles below strength. And that's going to depend on the world economy overall and what happens. Hourly, we're weaker than we were a couple of days ago. That's how the markets gained yesterday. In fact, we went from 94.80 to 93.80. The dollar lost 1% in 3 days. So since Monday, we've lost 1% on the dollar. That's a big market booster. It's been supporting things. And on the daily view, we gathered strength until suddenly went back down. But if we bounce off this 93 line, we might consolidate for a move higher. And that's going to hurt the metals, of course. So at the moment, they're a little bit weak. All right, we'll see what happens on that one. What else is cleanup stuff? Okay. So anyway, so on the whole, we're just in a very precarious position. Although, you know, it always depends on you. Let's go back to this. It always depends on your viewpoint. And that's why you got to always change your viewpoints. Don't get too tied up in one chart, because you got to have that long-term perspective. And here you'll see we haven't had any, this isn't even a correction. This is all we did is hit a point of resistance and got rejected slightly. How slightly? Well, that's where you'd look at the 5% rule, for example, and you want to say to yourself, okay, so let's say we can call this a consolidation at 25. We run to 35. And that means that it's a 1,000-point run. That means your rejections are going to be 200 points. A weak retracement is going to be 200 points down, which is what? 33. What line have we been using all week? 33, right? And the real line, though, because 2850 is our must-hold line on the S&P, so it's 2850 times 1.1 is 3135 is the 10% line, and 2850 times 1.15 is 3277. So right around this zone, 3277. Oops, sorry, 3277. And what did I say before? I forgot. Now I forgot what the 10% line was. 2850 times 1.1, 3135. So 3135 is on the must hold, is on that line. That means if you go up another 135, obviously from 25. If you go up another 2850 plus 300 is 3150. And so if you look up another 300, about 3450, and that comes up to 35. So we're in that zone of being within the 5% rule plus the technical rules where you hit these numbers. So if you get down 200 points, that's a retrace. And if you go down another 200 points down to 3100, where we already know that's the 10% line. So we know that's going to be a very, very significant point of resistance in this area, where that 3135 line is going to be extremely significant, because it's the technical resistance between 25 and 35 with a pullback, and a strong pullback too. It's also the 10% line. So there's many reasons that line should hold up. If that fails, you got bad news probably all the way back to 2850. So 3135 is super critical to hold, and so far we've been holding it, but you can't count on it. And meanwhile, this is nothing though. This is just, all this is a pause on the way up if this keeps going, but I don't think it will. I think that, like I said, if we're looking at this thing on stock charts, and it's not all technicals, obviously. If you look at the resurging virus, if you look at the economy, if you look at the job situation, you look at the uncertainty around the election, those are the reasons it's going to go down. But also technical health. This is technical health. And that's where we are now. So bottom line, lots of uncertainty in this environment, and Doug's going to talk about trading in it. So first of all, Doug, how are things going? How's the quarter been?
Good. We actually had really good quarters on both funds. The growth fund was up 10% in July, 8% August. It's up about 8.5%, 9% this month. For the quarter, the
wait, what?
income fund
is up. Let's add those together. That's a really big number.
You want to compound it?
Not compound. I'm thinking you said 8, 8, and 12.
No, 10, 8, and about 8.5, 9.
Oh, 10, 8. Oh, okay. Only 31. Okay. That's better than I thought. Okay, good.
The growth fund, the income fund. Now, the income fund, remember, this is a very, just if you guys can hear me, the income fund is a very conservative fund. There were no tech stocks in it. There are no momos. There are very conservative, very, very conservative plays in there. I mean, the core of it right now, when we started and we've added to it and adjusted, is UPS, Costco, Walmart, Starbucks. We have, unfortunately, Gilead in there. That's been our only draggard. lows. But so that fund, which I'm looking to do, if we could do 14% a year, I'd be happy because we pay a 2% quarterly dividend. That's up net of all fees, 12.8% right now for the quarter.
Do you have a dividend as a fee?
And that's net of all fees. It was about 16.5% gross for the 3 months.
Okay. So guys, in case you weren't participating in it before, the income fund, the reason we set it up is because my mother and her friends down in Florida, they have a horrible problem because all their retirement accounts, which half of them use like Raymond James or something like that, all those retirement accounts that are supposed to pay them a regular income have been paying them like 1% a quarter or less than 1% a quarter. No, I'm sorry, not even a quarter. I'm sorry, like per year, 1%. So it's killing them because they used to pay off, you know, maybe 4, 5, 6% a year, and now they're paying them like 1%. They're annuity funds. And we had an article about that a couple of weeks ago on the main page. We were discussing the purpose of the fund and so on and so forth. But it's you know, if you're a retired person, you're living off that income, this can be a complete disaster for you. So so Doug and I were talking about it, and we said, well, we could set up a fund that works kind of like the butterfly portfolio, which is constantly grinding out cash and is relatively stable in up and down markets. And the idea is we're just going to keep selling premium, and then we could distribute some of the premium that we sell every quarter, so that people have an income out of the fund. And we decided that 2% was a good number because historically I looked at my mother's accounts and her friends' accounts, and I saw that, like, you know, 8% was very, very good performance. But those annuity funds, it's 8%. Your fund doesn't grow. Your money doesn't grow. We have a system where we're basically running it like the butterfly portfolio, where instead of putting all the money back in, we're putting some of the money back in and taking some of it out. Now, taking some of it out doesn't help the performance much, but it does allow us to have the best of both worlds, where we do have some growth. And in this case, it's pretty good growth of this quarter, but I wouldn't count on that. I wouldn't count on having 10% growth in a quarter. But of course, we always say that with the butterfly portfolio too, and it always seems to come through.
8, almost 13.
Yeah, almost 13. So
just so you know how the first dividend that's being paid out, if you put 100,000 in, which is the minimum, you would get a dividend in a couple weeks of $22.60. But your account, instead of being less, you know, or the same, would still be worth $110,740 after your dividend. So you'd still be up over 10%.
Yes, you're up 10%, and you're getting a dividend.
And you got your dividend, yeah, which is better than any annuity, any bond fund, and you know the average. I was looking at the averages on income funds. So far, I mean, just in the last quarter, you're looking at about 4% that they grew, 3 to 4%, and you figure the S&P is up a little bit more. If you did a hybrid of the two, which I guess would be a fair comparison for this, it's about 7-8%. So we almost doubled it.
All right. So now let's keep this straight though. It's we only just started this income fund. It's having a fantastic start. We expect to continue to do well. But this is beyond our expectations. I mean, we were shooting for maybe 20% returns.
Right, we're not looking for 50% a year or 60% a year, which we're on pace for.
Yeah, it's not the intent to go for these huge gains. We just happen to have some good
our conservative plays happen to be very good, and we've been I've been hedging the. What we do is we basically do bulk call spreads. Look at the different companies that we select and decide to pick on here, and I'll do a bulk call spread, write a put way far below the current price to begin with, and then we adjust them. We've already adjusted Costco twice. I've adjusted UPS already. I've adjusted Lowe's where we had new spreads opened up. Once we see about 70-80% of the total amount that we could receive as a profit on that spread, I close it out and open a new one, so we put basically less money at risk, and we take profits off the table.
All right, and again, I wasn't intending this to be a commercial, but people are already asking how to get into the fund, so it's like
if anybody wants information, they could just email me at doug.rappaport, RAPOPORT @hotmail.com. And Philip, I'm sure Philip put a link there or something.
Yeah, I'll put something in. Hang on, you should see it, I think. Oops. Okay, wrap report. Make sure I did that right. Send that to everyone.
Again, that's R-A-P-O-P-O-R-T.
What?
I know I was saying my last name is, yeah.
Yeah. So the fund is run like a hedge fund, except that we're doing the annuity thing. In other words, we're combining the concept of having the flexibility of a hedge fund and being able to do and running it so that we can make these payments, because that's really what it is for people. They just want to have some sort of income they can depend on, and that's key. But then to give it to these shysters, really, who put your money into something and then they go, oh, sorry, you're not making any money this year, what can we do? It's like, that's devastating for people. I mean, I can't believe they can do that. So then you have to draw down your account, and that's the worst thing you have to do, because if you draw down your account, then you're going to get less payments for forever forward. It lowers your payments. So in other words, if you're retired for 20 years, you have just enough money to live on, but then if there's some kind of tragedy or the market dips significantly, you're forced to cash out. And then when the market comes back, you have less money when it comes back, and then you're getting less returns. Then next time there's a downturn in the market, again, you have to cash out, and I have even less money going forward. It's very contrary to what people were intending to do when they retired.
And Phil, if you did an immediate annuity right now, say some people come to me, say I want to lose it, I just want dividends. At immediate annuity, at the rate right now they're paying, you are basically just taking your money out year by year and it's withdrawing from the money until it's gone. You're getting almost nothing. I mean, you're making a few $100s on maybe 100,000. So all they're doing is giving you your money back.
But you do have to be a qualified investor to do these funds, right?
You have to be accredited, yes.
Accredited, yes. So unfortunately, that's the only drawback, is you still do have to be an accredited investor. One day we hope to set up like an ETF kind of thing for this. But right now we just have to prove out the system so we can build it up. And anyway, so going very well. And let's talk about some of these trades. Can we talk about some?
Sure.
Like what are we actually doing? Let's take a look in Thinkorswim and see.
Well, I can tell you on, say, for instance, on the Costco trade, that's our biggest position in the fund is Costco. We got in around, originally I think it was 320s. Stock did really well. We closed out one spread. We put another one in. When the stock came down from 365 to 331 at one point, it hurt the fund a little bit. But how the hedging works, we had calls, extra short-term calls. I always have against it to protect against the fund. I can always roll those up. Those are only for the week. But if the stock goes down, we're somewhat protected. And when earnings were coming out, which I knew, Costco reports their same-store sales at the first week of every month. They were beating it. They were crushing it every month. So we knew their earnings were going to be good. So when the stock came down with the market, I knew it was an opportunity. We wrote actually extra 337.50 puts into those earnings. And then we also had some calls on the other side. So we made a lot that day and caught up quickly. So
you're saying we crashed down to 331.
Yeah, and we still came out. We're ahead in Costco for the month.
337 puts.
337.50 puts into earnings. And also we had the 360s calls.
And we had the short 360 calls. So guys, you see what's going on here? Doug is basically taking the concept of the butterfly portfolio, wherever that is.
We're further hedging it.
And he's actively hedging it. So it's you get a little bit of an additional kick from that. What is this?
Yeah, we got a big kick from that.
There it is. Found it. Okay.
So even with Lowe's still down for the month and Costco is still lower for where it was for the month. Gilead lower for the month. We're up for the month.
Yeah. So let me show you guys on the butterfly portfolio what kind of plays we do. So in other words, we don't have Costco in here, I don't think, but no. But conceptually, what we're doing is we have a position, like in this case, we have Amazon where we have the 1,700, 2,000 spread. We have 6 of those. We sell a couple of puts. We sell a couple of calls. And then we sell, and here we sold some more shorter term puts. So we have long-term puts. So the base position is these three. That's our base position, is the 17,200 spread with the $1,000 puts. I have no thought whatsoever we're going to have to pay off the $1,000 puts. In fact, we can probably buy them back at this point. And this spread is good for $300 times 6 is $180,000. And then we sell some short puts and short calls while we wait. That's all. Very simple strategy. So Doug's engaging that kind of strategy, but the difference is when something is long, when something makes a move, what the heck happened to that Costco thing? Oh, it was in stock charts. So when he gets a spike up and when he gets a spike down, he'll actively adjust the position to take advantage of the move, because he's trading the channel, where even though it's spiking up and down, we're still in a basic channel of going up. Basically, this blue channel is the bottom in this case at the moment. And then there's an imaginary line that goes up here that's the top of the range. So this is a rising range that's up here. And of course, we're all very cautious, but as long as we're above this 50-day moving average, we have very, very strong support going forward. And you see, unlike his PPO line, unlike the S&P itself, Costco is in a very beneficial move right now. You can see this probably got a lot of strength. That makes it very unlikely it's going to fail this support.
Yeah, and typically, by the way, I don't write the puts as much. I really write the calls, only because we have a lot of naked puts as part of the bull call spread. So if the stock does go down, it hedges. If the stock goes up, we're still up. If I write a 360 call for next week or 357 call, 50 call on Costco, and the stock goes to 362, those calls might be down, but overall our position is up a lot, and I could just roll that call. But if it goes down, we're somewhat protected.
All right, so that's great. So that's Costco. What are a couple other guys that we have in there?
Well, UPS we got into at 119 when it was down there. Now it's 167. It was just at 171 the other day. We already adjusted and opened a new one on that one.
How did you deal with that when it went up so fast? Because we're not looking for that either, right?
No, we aren't. That was great. Yeah, because we had
we
had the 105. We had a 120. We had I think we had at the time, it was a 115, 135 spread. Or maybe it was actually, I'm sorry, it was 110, 130 spread with 105 puts. So we easily closed that one open. We opened another one that was a 130, 150 spread
130
with 105 puts.
Yeah, and 105 puts were right down here.
Yeah, and then we rolled that into a 130, 150 with, let's see, I'm going to it right now. And the puts were down to 120, 125.
Mm-hmm. 125.
And that's what we currently have. That's what we currently have.
So you never sold a lot of short calls against Costco, against UPS.
We did, by the way, all along. Say the whole spread maybe cost us after the put $4. Writing those calls that expired worthless, our spread actually cost us nothing. We have zero risk as long as it holds above the put. And that's part of the reason we're writing the short calls too, is it reduces the price of the spread to zero.
Mm-hmm.
So at this point, we're playing.
Key, guys. I mean, we're in these positions for the long haul. These are 2022s, right?
No, these are January 21s.
Oh, the bull call spread is a 21.
Yeah, I've been doing the 21s. We've been seeing much because of shorter term. We've been seeing a much greater increase. That's what I've been writing.
That's a lot more day trading than I am, because I'm always planning on things for like 2 years, 3 years.
Well, we did this in July, so it was half a year. Yeah. And then soon the next ones that we do will either be June or January of next year. So we're going to go a little further out. We're not doing any more January 21s. All
right. Because I like to just go long, and I figure I'm going to trade the position for 2 years generally. I think the butterfly portfolio, they're all pretty much all the longs at 2022, 2022, 2022. See, everything's 2022. So I'm more of a long-term trader in my mentality. But you don't argue with the guy who's up 12% for the quarter, right?
So 13 and net.
13. All right. Excuse me, 13. And that is that's after fees, so that's good. Anyway, so on UPS, so what else are we into here? And notice, by the way, it's what I always tell you guys, okay? This is a good conservative fund, and we're trading blue chip, blue chip, blue chip. And we're taking conservative positions. We're not going crazy. We're not saying they're going to go to the moon. We're just playing them to stay in their lane, basically.
We took a position in Lowe's back when it was in the 130s or early 140s. And we actually closed one down. I think it actually was in the 130s when we first took a position in Lowe's.
There was some spike down they had.
Well, actually, it did have a spike down, but it looks like it has a lot of support around 152, around there.
Yeah, because that likes your 50-day moving averages creeping up along this line.
So now we closed that one, opened a new one. We on Lowe's, and by the way, on these spreads, we're buying the call way in the money. We're writing the call maybe only a few points above where it currently is. And with the put, we're still making, and with the added put, which is below even the call price, we're not paying that much for the spread even from the from the onset. So it really doesn't have to move at all for us to make a decent amount of money. And if it does go up, we could easily close a spread, usually right after earnings when they lose a lot of premium. So on the lows, we currently have, which we did, let's see, we have a 135, 155 spread. So we're at 11 points, out of the money on the call, and we have puts at 140 on that one.
Oh, okay.
So we're
so let me ask you a
stock
question.
to come down 11 points by January, and we're still fine.
So when
and
you say
Lowe's is crushing it too, by the way.
Yeah, I know. So when you say that you're selling close to the money calls, right? What's your logic there? What do you do what do you consider why do you consider it a ceiling? What do you primarily go by?
Well, right now, I mean, if I see it, first of all, I don't sell into weakness. I only sell into strength. So on a day, for instance, like today, it's up $4.67. It's the last day of the month. It could be window dressing. I'm right. I wrote today the next week 170s on Lowe's.
But what do you take into account? I mean, because me, I'm a value guy. I'm just looking at I just see a top of a channel and I decide that for whatever factors, I'm like, it's not going to go any higher.
Well, a couple things on here. 170 seems to be resistance on Lowe's. Yeah. So it was a good number to write on, which is why I didn't go 167.50, even though we could. The other thing is I just don't care if it goes higher, because if it goes higher, that's great. We made money and I could roll it up, that we're profitable. But if it goes lower, that's why I always try and do it close. I'm protected at least from 2 points on our position because I write the equal amount on our position.
Right, because we just had that conversation yesterday. Yeah, in chat yesterday we had that conversation because I was saying I don't like to sell things so far out of the money. I'm like, why don't you make the money? It's like I'm not scared of it going up. We already have a long position. It may
my worst case is it goes up so much, and I don't pay attention at all because for some reason I'm not at my computer from morning to night, which is never happening. But I closed it out. We made money. We just made less.
Mm-hmm.
If I never covered, but I usually would roll it way before that. You could always roll it out.
Because people forget the short calls are a hedge.
That's all it is. Exactly.
This is how we make sure we don't lose money. And we're limiting our upside, but I don't mind limiting our upside when our upside is 50% a year.
Yeah, and so actually we're not.
We limit to 50% a year, but we have a far less chance of not performing.
And we're not really limiting it because I could roll it to the next week or the week after.
Well, just in case you came in here at 90 and it went to 160, we're not going to capture that move.
Right, except I would, when it was 90 something, I'd be covering it way before that.
So yeah, that's obviously a lot of months. But I'm just saying, but conceptually, if something happens really fast, we're going to miss.
Right, we would close the position out as small profit.
Here went from 60 to 90 in like a week. So
if it did let's say it did it overnight on a buyout or something like that, and I never had a chance. Yeah, we would make less money.
But anything else, it's rawhide. We're rolling. That's what we do. We just roll the thing along. We've got all the time in the world because we intend to be doing this for 20 years. And that's one of the things that you don't get into is when you're a trader and you're not thinking in terms of the whole position over the whole time you're going to own it. You start fixating on the little window that you're trading in right now, but that doesn't matter. That's going to disappear. And even now, we haven't really embraced the 2023s yet because they aren't trading very much. But here you go, right here. In fact, it's not even open on the screen. So here's Costco is all the way out till 2023. So we already have, Doug's into the January 21s right now for the position. He has a roll of 6-month roll, another 6-month roll, another 6-month roll, another 6-month roll for the main position already laying out in front of him. He can erase a ton of mistakes with that kind of thing. And something has to go very, very badly wrong for us to not be able to deal with positions. And again, that's the point. The point of these portfolios is not to hit a home run, but to try to hit a lot of singles.
And we also keep a decent amount of cash, by the way, in the portfolio too.
Right. That's also critical because you can make 50% using what percent of cash you in now? Like half?
No, we have about 30% of cash.
30% cash. So you're having 30% cash. We're making this kind of money. You don't need to deploy any more cash. And this is, again, another thing traders keep getting wrong is you say, well, if I'm making 50% with 70% of my cash, then if I take all my cash, I'm going to make more. I'm going to make 75%. That's great, but the problem is you expose yourself to a danger if it goes down. Whereas when you have 30% cash, we have the ability to make huge adjustments and even take advantage of a downturn. And that's
that is what happened this month. We're seeing a lot of cash. I said we bought no tech, whatever. We did add a very, very small position of tech this month. We bought the 110 January 22 calls on Apple for $15. They're now at 23.
Okay, Apple.
The 110s for January 22. Do
you know when you bought them?
Yeah, we bought them when the stock was around 105, 104. We almost nailed the low.
Yeah. So there was 105, and Doug said, screw that, I'm just going to buy calls.
Yeah, we actually bought for 16 and change, but I wrote short. We don't have a long cover on that yet because I just thought it was way too low. But I've been writing weekly on it, so we reduced the price by almost a couple points already. So our net price is about 15 on it.
Fantastic. And again, you got to look. This is a daily, doesn't really tell you anything, right? Then you look at the weekly. That's why I love the gallery view. It's called the gallery view in stock charts. I always like this the best to look at every position because it gives you a daily, the hourly, the weekly, and the daily and the weekly. And I love to be able to move between the views to get an idea of what's happening. What it tells you, see, daily, Apple's it's coming off the 50. It held the 50. And now it's gathering some strength and it's probably going to head back up. And we have earnings again coming out in the not too distant future. On the weekly view, again, look how shallow that dip was there, really. Okay, ran out of strength, had a little bit of consolidation, but look how shallow that is right now. See how this is coming? It came below, but it's not really, it doesn't look like it's really enthusiastically heading down. We didn't even come close to the 200-day moving average. We bounced off the 50-day moving average, and we're here. But then, of course, like I said, I'm very different about this thing because I only, I don't want to say I don't use charts because I do. I just like look at them for a second. I'm like, oh, okay, so strong, weak, this, that. But what I care about is obviously what are they making? How? So here's Apple. And they're at $2 trillion. 116 on Apple is $2 trillion. They're making $35 billion. All right, and that's I can't even do the math. What is that? 20. That's 200. Wait, no, it's 2,000 billion, right? 2,000 billion dollars. That's so crazy. Divided by $35 billion. So they're trading at 57 times earnings right now. I wouldn't bet they're going to go that much higher. I don't think. Yeah, Doug, how do you justify that? I mean, I think it's a little too high for Apple, frankly.
What I justify is, look, I'm waiting a year from now. Apple I will be adding a long call to this. I'm just right now because as you saw, the stock has gone. Since we bought it, didn't pay to write the long call yet because we already made almost 50% on it. We did make about 50% on it.
I don't
But
see it.
well, I want to write. I'm probably going to write a 130 call or 135 call on it, because if it just goes right back to where it was, we made. I think it'll be. Let's see, that call should be, and but we'll make. I mean, it'll be over 100% of that spread.
Right, but I'm saying, like, I know if you think about it into earnings, which you're going to come around.
Oh, I don't know how much higher it goes. I think it's going to stall out in the 120s. And also, you got to remember, I'm also very cautious, so I will be adding a long call before November. In October, I will be adding it. You don't know what's going to happen with the election.
No, I know. That's
if there's turmoil, this market could fall 20%.
Yeah, and Apple's not going to be immune because Apple's just way too.
Apple's going to be one of the ones that'll come down quickest. Yeah.
Yeah.
Just ran up so much. It could easily come down to the 90s.
200-day moving average is way the hell down there. That's a long way to go. 85 is the 200-day moving averages. It's hard to have a sense of proportion, but my sense of proportion is $2 trillion. That's where we're at now. We're already at $2 trillion. I don't care how good your company is. $2 trillion is a lot of money. 1995. There's a reason that Apple is stuck here, and that's because it's $2 trillion, and they're only making. I'm sorry, it's 35. I'm sorry, it wasn't 35 billion. I did that wrong. It's 35 times earnings. Their earnings is 60 basically. That's the difference. So their earnings are 58 billion. $58 billion is their earnings. They're going to go from 58 to 60 something next year. Still, though, it's a big stretch to say $2 trillion. So I do that math before. But to say that they're worth $2 trillion is kind of a stretch. It's very expensive. They're not growing all that fast. I don't know what else is on the horizon for Apple that's going to jack their earnings up, except for 5G. I think 5G should be helpful for them. But even if they get to 70, they got to get back to like almost $80 billion in earnings, which is quite a stretch. It's like 25% higher than it is now. They have to get to like $80 billion a year in earnings before $2 trillion becomes a reasonable amount. And that's kind of hard. That's a lot of work for Apple. So we'll see. But and in the long-term portfolio, I think we cut back our Apple position in the long term. In the butterfly, we have Apple. We're being hurt by the short 8750 calls. So I already determined a while ago. But these are the October 8750s. We're going to have to roll these. But we sold them for 12. They're at 28. We're not that far off the mark actually. And we got the 75-100 spread, and we're at 115. So we're in great shape on this position, as you can see. But we'll have to roll these calls along and fix it basically. And I think the long-term portfolio, I don't know if we have much Apple left. No, we don't have any. Haha, see? So we totally took out, we took Apple out of the long-term portfolio. It just got toppy. I don't want to bet against it. I love Apple. I think it's a great company. But I didn't want to be too gung-ho bullish on it at this point. And I would like to see it pull back. And believe me, the second it pulls back, I'm going to jump all over it. But at the moment, it's a little expensive. All righty. So let's see. Where are we? Anything else exciting in the portfolio, or what you made a ton of money on something? What was that?
Well, Costco, we made a ton. We made a lot on UPS. A tremendous amount of UPS too.
That went up like a whole bunch in one shot.
That was UPS. UPS really spiked up. UPS, Costco, Lowe's, had also. I mean, they all spiked. The stocks we happened to pick in the portfolio were some of the best staples you could have bought, actually, and that's some of the best timing. So we got Lowe's low.
That's what we did during the crisis, right? We find good stocks that are still
cheap. This wasn't even during the crisis. Remember, this was when the market was screaming back. This was in the second week of July we started this fund. So none of these, we had no positions till the second week of July.
Where is
we also have Walmart, by the way. Walmart we bought at about 118.
Well,
we did that spread around that time.
I know. But you say we not a crisis, but realistically, in the second week of July, we were still quite low compared to where we were below where we were.
Right. July and August were huge, and then September we're down. We actually September the S&P is is basically down a little bit. I think we're over 3,400.
Our watch list. That's what we did. I mean, we took the things that we liked and said, who hasn't moved up yet? why am I going to chase the ones that have moved up when we can get the ones that haven't moved up? That makes sense.
Well, actually, it was even more than that. I was more selective because we didn't know what was going to happen. We still know what's going to happen in the second half of the year. So when I was picking stocks for the income fund, being that this is a super conservative fund, we have to preserve because we're giving out. I picked stocks on top of that. All these stocks, the names, if you notice, these are all pandemic proof. So they did well during when the shutdown, and they'll do well if we shut down again. That was part of the reason I picked all these names.
That's right. You got to take your macro environment into account. Okay, it's just because the airlines are cheap and cruise ships are cheap and whatever, it doesn't mean we think they're going to be successful moving forward. Even something like Disney has too many issues to start betting on. We just saw Disney take another hit today because of the park shutdown. They're not going to reopen the park in California. Right now, I'm like an AT&T. I think AT&T is always cheap at 20. When you're at 28 with AT&T, I think that's a good one to play. There's Pfizer. We just added that one yesterday. Not to the fund, but we added it to the long-term portfolio yesterday. And look, Pfizer's in a channel, but what I'm worried about with Pfizer is that they are going to come up with a vaccine or some treatment. Doug likes which was the one you wanted?
Well, I think Johnson & Johnson has the best shot of having a universal.
That was an interesting premise. Yeah. Pfizer, though, is so good for the money that anything to do with a vaccine would be a bonus for them and just extra money. But they're so cheap right now for the money, I can't ignore those guys. Johnson & Johnson, my objection to them is valuation. They've already had a big boost for value. But they are still in a nice channel here on that basis. They're in a nice long-term channel. There's nothing wrong betting on Johnson & Johnson, especially for the kind of bet we want to make, because there's nothing we like more in the butterfly portfolio or for this fund, than something that is volatile within a channel, because that means that we have an opportunity to buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high. Every time we do that, we're increasing our returns because we are able to take advantage of those gyrations because we're actively managing the fund. And that's key. And as you guys know, when things are bad, the volatility spikes and we're able to sell puts for a really good price. We're able to sell short puts for a really good price. We have a lot of opportunities to make money. And these things, this is a weekly chart. A lot of these times on a blue chip stock, you can pretty much count on it not lasting. There's an overreaction. You take advantage of it. Overreaction, you take advantage of it. And within a few weeks, it's all fixed. And that's what we do. We take advantage of it while it's down there. And we pick a number. And even visually on a chart, though, you can figure this out. There's good support at this 115 level. And just because it got broken once, we know this was a weird situation, right? There was good support on a weekly basis. It went a little bit below that support because everybody was panicking. But here, great support 115, great support in the 115 zone. You can see where you want to get in, and you can see where you want to get out. You want to get out around here. So you get in here and you get out here, and you can play things for years like that. It's not a Be the House video. It's like, I think it's I forgot now. I think How to Buy Stocks for a Discount video. It was made like more than 10 years ago, and AT&T was our example. AT&T was like $30-something then. It's always $30. And why is it always $30? Because they pay out a big fat 6% dividend. So they're paying the profits out, and it doesn't give them room to grow. They can't get much further than 30. So whenever AT&T is down around 30, I want to buy it. Whenever AT&T is up around 36, I want to sell it. And I mean forever. That's how you play that stock. And I want you guys to get out of the habit of readjusting your expectations for stocks just because they went up. That doesn't change the stock. The fact that the price went up doesn't mean the stock got better. It just means the price went up. So, I'm talking about this stretch of time. Oh, look how good you can do that. Well, you can't really tell like this. So somewhere around here. And here's my number for AT&T. I like to get in when it's at 30. And if it goes lower, I don't care, I'll buy more. But in all these years, in the last 10 years plus, AT&T bottomed out at 22 and it topped out at 42. But generally, you could argue 32 is a price, but I don't consider 32 a bargain. I do consider 30 a bargain. I think that's a good price. I do know it does go lower when it's at 30, but 30 is when I want to start accumulating AT&T. Oh, and another good one. Let's see if I can fix this. Messed up the chart. Another good one is China Mobile. Now we have issues with China, and there's the talks of delisting things on the exchange and everything, but that wouldn't affect a big company like China Mobile. It affects the startup companies in China, but also really cheap. Okay, this is like the AT&T for China. I mean, they got 700-800 million subscribers, something like that, some insane amount of subscribers. AT&T's got like 150 million subscribers. They have 800 million subscribers. It's controlled by the state. But basically, if they just get allowed to have a tiny little price increase, it would make such a massive difference in their profits. And eventually they will, plus 5G is coming out. This is a very powerful, very large company, and it's good to invest in at this price. And I think they pay dividend too. Let's see what they pay. Yeah, look at that. So the PE ratio on the stock is 7.39. They make $4 a share. They pay a $2 dividend, 6.2% for China Mobile. And you know that if we make a play on that, we can turn that into a lot more. So what do you think about that one, Doug?
Looks good to me.
But how do you want to play it? Do you want the dividend? Do you want to blow that off and just turn it into an options trade?
I always think of the option play is always going to be better.
The dividend just
because I'd rather do the option play and write a put. And that's your dividend. The problem with
China Mobile is that I think that's why I went with AT&T. Yeah, the problem with China Mobile. Oh no! Look, they got long things now. Oh, they didn't have that before. Oh, now I'm liking them much more. Look at this. They added 2023s. They didn't even have 2022s last year. This is huge. Okay, so they're at 32. We think 32 is a good price. It's 7 times earnings, so it's obviously a good price. We look for a reasonably priced put and a reasonably priced long. And so it's at 32. We certainly think it's going to be over 35. We think it's going to be over 37. But look at the difference, though. Look at that drop off. It drops off from 230. See, 282 was the last call. So that's probably reasonable. So figure 282 is correct. This is not reasonable. 260. It's certainly not at the top of this range. So, and then you look at the delta. I don't have the delta on this one. But you figure that if this is 32.50 and this is 35, this is probably $1 lower. So if that's 360, this is probably 260. And is it worth it for us to give ourselves 250 more headroom for $1 less protection? Probably is, because we feel strongly that it's going to go higher. So then I say, okay, so let's say we're going to sell that one for 260, but I don't want to go all the way up to 37.50. Then I'm only going to collect 180 maybe or something like that, and I'm not sure that that's worth it. And then we look down and say, well, what do we want to go for the long? So you say, if I'm going to collect 260 here at 37.50, oh no, sorry, at 35, if we spend 650, see that 8 is wrong, it's a long time. So let's say we can get these for 650, the 27.50s. So 650 minus 260 is going to be like $4 basically, or a little under $4. And then we say, well, what can we sell against it? So we're talking about taking the 27.50 35 spread for $7.50. It's a $7.50 spread, and we're going to buy it for $4. And if we can offset that and say we're very comfortable with this price, 32, so we could offset that by selling these 27.50 puts for let's just guess 360. 350, 360. So we sell those for 350, 360. You only have to sell a third of those to knock $1 off the price on the longs. So if we are comfortable owning, let's say $30,000 worth of these, right? Then we could sell 10. So we could easily sell 10 of these 27.50 puts, not even a problem. And that's going to give us $3,500. and then we can buy 20 or 30 of these spreads, and that would be, again, the 27, 50, 35 spreads for $4. So that's going to be, if we do, let's say we do 30 of them, it's going to be $12,000. So 12,000 minus 4,000 is 8,000 total dollars, and we have 30 of the $7.50 spread. So that's good for $22,050. So that's all it cost us to be in a $22,500 spread. And then we can make money selling short calls. And then we move over to, let's say, basically December. I mean, I don't like selling December because it's not. Oh, isn't that weird though? There's no Januaries. Well, I don't like selling December. I don't like selling December usually because they're not traded as often. I don't want to be in a thinly traded option if I can avoid it. But que sera on this one. So you've got your 15 longs, and if we sell 5 short 3250s that are at the money in December, we're going to pick up $700, let's say. And $700 doesn't sound like much, but we only laid out I forgot 8,000. We only laid out $8,000 for the spread. So if we do this 10 times, and we've got 800 days to sell, so we're selling 70, 80 days. We're selling 1/10 of our days for $700. That in 10 sales, just selling 1/3 cover is going to pay for the entire spread. And then, like Doug said before, you have a free spread. When you have a free spread, that means anything CHL is above here is pure profit for the position. So what are we doing? Remember what our goal is in this fund. Our goal is to give our people 2% every quarter. So is this going to accomplish the goal? Of course it is, because every 80 days, which is every quarter, we're making 10% on this position. It's an $8,000 spread. We're selling 10%, $700, practically 10% of premium. And as long as we collect that money, we're giving 2% each quarter to our shareholders, like we intend to, and we're also putting 8% back in the pile for cash to make profits, which is basically the whole strategy in a nutshell, and that's exactly where we are for the quarter. We're actually ahead of the game, but that's our planned strategy, is to do things like that. And honestly, you don't need us to manage your portfolio. That's what we're doing here. We're teaching you how to do this stuff. If you don't have the time to sit and pay attention, Doug is a professional money manager. If you don't have the time to sit and do this all day, or you have better things to do with your day than that, and a lot of people who have substantial income do have better things to do with their day. They can go out and make some more money instead. You know, it's something that you do, that's well worth it to have a fund manager oversee this, because it's a phenomenal strategy if you manage it correctly. It's also very, very well worth learning. Doug, you got any comments on that?
No, you said it all perfectly.
Ah, amazing. I'm amazing. All right, let's see if we have any questions. Oh, probably do. Look at that. All right, so John says, during the big downturn in March, didn't you need to add money to the butterfly portfolio? What happens when there's another big downturn? Not if we don't have, well, first of all, we didn't actually need to add the money. I added the money as an opportunity. The butterfly portfolio was down about 50%, and I wanted to get the cash off the sidelines. That's why this butterfly portfolio is way up this year. That was my strategic. Now, what are you going to do, Doug, when we have a March kind of event?
Well, if it looks like we're going to have a major sell-off, what I do is I flip the puts, which are way out of the money to begin with. It's very easy to flip them into extra calls, those long-term puts. So those go into now. So now we have.
Okay, whoa. I'm not going to let you off that easy. Elaborate on that concept.
Okay, so say, for instance, on Costco, we have 305 puts. Stock's 357. Say it came down to 340. I can easily flip those to 390 or 385 for the same premium. As the stock's going down, well, now we're making money on those extra calls. Spread's going down. It's covering the difference. We're not losing money on the puts, and I could also write extra calls on top of that. You know, so I would do that, but I also add shorts. I mean, there are stocks that we know and that we did in the growth, actually in the growth portfolio, if you remember, I think we were up 20% in March. And the reason for that is we were shorting Disney. We shorted Disney. We shorted Expedia. We shorted Royal Caribbean. So you know there are going to be great
By the way,
short, and also Marriott. We did, and
his idea entirely to short Royal Caribbean. Because as soon as people started getting sick on cruise ships, Doug called me up and said, "I think we should short the cruise lines." And
so you know we can write barefoot spreads. Yeah. We're not limited to just bulk call spreads. So we go both ways. I mean, we are a hedge fund.
Yep, that is a very valid point. Also, again, look at who we're picking. You know, the S&P fell what, 40%? Is that correct in March?
Yeah.
Okay, and Costco here went from 320 to 270.
Well, I think at one point in March it came back a little bit near the end. Yeah.
Yeah. No, I mean on the extreme, but the extreme for Costco was 320 to 270, which is $50, which is 15%. It's not as volatile as the S&P. And again, that was Doug's premise for picking these stocks, was we were looking for stocks that did not have that kind of volatility and did not hit you that hard in a downturn if we could avoid it. UPS,
and that's not going to change, by the way, going forward.
It's not going to change. No,
not until the vaccine's out and everything's good, that we're going to stay like that.
Right. But until we feel that risk has been removed from the market, I have no desire to play the kind of stocks that are going to get knocked around by that thing. So, and also you have to take into account stupidly low, like something sell off stupidly, like UPS didn't really go below 85. It did go to 80, but that was just stupid. It happened over a day or so of panic. It really wasn't, it's nothing UPS did and it wasn't their fault, and they bounced quickly back. But again, that's why you always want to have cash in your portfolio to ride that kind of stuff out.
Yeah, look, I wish I bought Lowe's. You know, we had this fund earlier, and we were able to get Lowe's in March and Home Depot because they came back really quickly. I mean, no one knew how to value anything, so everything was just sold because it was all through ETFs or funds.
Yeah,
so everything was just dumped.
That's the thing. Well, that one died. Wow, that got hit hard. Home Depot, holy crap.
Yeah, you know, and they came back because Home Depot's actually doing better business than they did last year, and same with Lowe's. I know store comparisons, they're beating it right now by about 30%.
That's crazy. So yeah, you guys, you just gotta pick the right stocks for an environment, and you have to look back when there is a crash of some sort. You have to look back and say, how quickly do these guys recover? How stable are they? What is their business really like after a situation like this? And we talked about that back at the time also when we were picking our own stocks. What's the cost of these hedges, SK is asking? That's a weird question. It's an opportunity cost. I mean, for the most part, we're selling short-term puts and calls. So, for example, I get mixed up on what I'm at. So, for example, if we were just talking about China Mobile, okay, so we take a position that's going to make us $22,000. All right, so not make 22. It's going to make $14,000. So we have an $8,000 net position long that's going to make $14,000 if if China Mobile is up above $35. So that's our target price. They're at 32 now. If they get to 35, we are going to be up for a fact $14,000 basically. So that's our goal. Now, what do we do? So what is the cost of a hedge? A hedge doesn't, the only cost of a hedge is the opportunity cost. So if I sell the 32.50 at the money, the December 32.50 calls, I'm going to sell those calls for $1.50, $1.40, whatever it works out to. I might decide I'm also going to sell the puts, which in this case I would because it's pretty low, but I wouldn't be too risky because I don't really want to own a lot more. But if I sell the puts for like 60 or 70 cents or 75 cents, I'm going to pick up another, and again, 5 puts, 5 calls. First of all, they can't both expire worthless, and now instead of collecting $1.50, I'm collecting $2.10, $2.20 times 5. So now I've collected $1,000, $1,100. Now, is there a cost? The cost is the margin. When I go to sell a short call, it's going to have a margin cost. So it's almost like a naked. Probably you don't have a portfolio margin in the hedge fund. We have portfolio margin, right, Doug?
We do. Yes.
Yeah.
We don't use it.
So it doesn't cost very much at all, portfolio margin wise, to do these things. But
yeah, when I say we have 30% cash, that's cash. I mean, margin room, we probably have about 60%.
Okay. So if we sell 5 of these guys, and this is true in the butterfly portfolio too, it's a very surprisingly very low margin drag on these positions because we're hedging against ourselves. The buying power, look at the buying power effect, 0. It has no buying power effect on us to sell 5 of these short calls. So that's not even portfolio margin. It just doesn't have a buying power effect on that one. If we have the short puts, they offset the short calls, so very little margin cost, and there's no financial cost. The only problem is if China Mobile, after you sell the 5 short calls, goes flying higher, whoops, CHL. So I'm just going to try to find a point at which it does that. Oh, here you go. So let's say we sell the 32.50 puts and they fly up to 36.50. Well, what happened? I sold 5 32.50 puts for $1 and now they're $4. So we lost 3 times 5 puts is $1,500. We're down $1,500 on the short puts that we sold. Now, I'm not going to immediately react, but that's the reality. But we're down $1,500 on the puts, but our position is clearly now in the money for $22,500. We've got a $14,000 profit coming to us against our $1,500 loss. So we could take that $1,500 loss and live with it, or most likely we're just going to ride out the position, see what happens. Well, it turns out a month later we're back to 0. Then a month later we're back up to losing $5. Now a month later we're back to 0 again. So that's why in the butterfly portfolio we don't panic about these things. We make an adjustment when it hits our time frame, or if we think it's hopeless. Sometimes it can be hopeless and we have to adjust, like Tesla 3 times this year. It's been hopeless that we've been too short and we've had to make an adjustment because we said this is not coming back. It hits a certain point, you say it ain't coming back. But well, it goes to Tesla too. But in China Mobile's thing, nothing fundamentally changed about China Mobile in this period. So there was no reason to roll it out. We just ride out the changes as it goes forward. It's a volatile stock, but it's volatile inside of a nice trading range that you can predict. In this case, it happens to be a downward trading range, but we now feel this is going to be the bottom of that trading range, and now we're going to stabilize and go up, which makes it a really, really good time to invest in these guys. So that's what it is. So the cost is mostly an opportunity cost, not a financial cost. You do have to, it does depend on how your broker does hedging. If you're in a retirement account, they could charge you quite a lot for short calls. You may not be able to do it. But again, if you're an accredited investor, what is this thing saying? Anyway, if you're an accredited investor and you can have somebody manage your money, that's another reason you might want to do it, though. It's because you can't use an IRA for these things, Doug?
For the hedge funds?
Yeah.
And in our hedge fund, we do accept IRAs. Yes, we have quite a bit.
So there you go. Because in an IRA, you can't do this with the margins, but in the hedge fund, we can. So it gives us a tremendous advantage to do things you can't do with an IRA. Does that go for 401k too? It's the same thing?
Same thing.
Yeah, so if you have an IRA 401k, and you use that money in the hedge fund, the hedge fund does the trading for you, makes the money for you, you still don't pay your taxes, and we have the margin. So that's actually a really good solution. I never thought about that so much. That's actually interesting. Because people always come to me and say, oh, I can't do this in my IRA. And it's like, oh, you should probably put it in the hedge fund then. So
you can do the call and write a call against it if you get adoption approval. You can't write a naked put, though.
Right. No, I'm saying you can do the short calls, but that's
right.
You can't do a short call against the spread. That's the problem. Then it's
well, right.
So this opens up strategies for those kind of protected accounts that wouldn't be open to you otherwise. The only thing is you don't get the fun of doing it yourself. You have to let somebody else do it. Bernie says this looks more volatile than This looks more volatile in day trading than a conservative portfolio, adding risk and volatility. I mean, look, it depends on how you look at it, but I don't think it's volatile. I think it's just we're making minor adjustments, right? Wouldn't you say so, Doug?
Yeah, we're not running a lot of calls against it. We're just running the same amount of the position of what we have, and which also matches the puts. So we're balanced out, actually. It's actually more conservative.
Yeah, it's like surfing. It's like you get on a surfboard and you tilt your body to make a major adjustment, but mostly you're making very minor little twitchy adjustments to keep yourself balanced. And if you are already balanced, it's very easy to manage those little adjustments. If you're off balance, doesn't matter how many little adjustments you make, it's not going to help. So we start off with well-balanced positions and then make minor adjustments along the way. That's what those weekly trades are. And anyway, you've seen this over year in the butterfly portfolio. That's exactly how it works. Bernie says, Bernie said, I take it back. Like January 21 long calls is craziness. I don't know what he means. Oh well. Todd says, join late. Sorry, blah. Covered. Oh, yesterday.
Well, I give you an example of a position we just did for January, actually, because that was the last one. When Costco had their earnings, we had 300 330s. We had a 300 330, 50 on those, which we paid nothing for, by the way. We actually had negative. It was a debit spread at that point. So we made over 150,000 that, and we opened it up into 75 calls. This is when the stock was 342. Let me just go to it. We currently have on that now. Oops, hold on. We have 75 340s. I'm sorry, 320s by 340s with a 320 put, and
right.
that cost us $1 at the time. So we actually did the cover of the spread was $2 below where the stock was trading at the time. Well, now it's $17 above.
So SK is asking, how many positions does Doug's fund have at any point in time? What's the maximum allocation per position?
We usually put, it depends on the position, but generally because it's not a lot per position because we're writing the covers on each thing. So even, for instance, even on the Costco recently, I mean, if you don't count the put, the margin of the put, let's see, that was 75 times 15, so it was about $100,000. $105,000 on there. So we have quite a bit of positions. We have
10%.
Yeah, and we also, by the way, have one major hedge for December after election. We have no puts, but we have just a bulk call spread on UVXY that we paid $1. Every dollar we paid is $25 of protection potentially. So when you ask what happens if the market falls 20% or anything like that, we do have a hedge in there too for that.
As we always should, folks, right? You do not, this is not the kind of thing you want to let run without having proper projections.
Currently, we have 9 positions, by the way, in the income fund, but we also have been in and out
of ultra for the VIX, right? So if the VIX starts going up, UVXY spikes up. And this is what Doug is like. If you're, we're down at 19 now, $20, but we in March you were down at 10 almost on the VIX, and it went up to 135.
Yeah. We have a 25.50, so this could go to 50 in a heartbeat if we fell hard.
He's got the 25 calls that he bought for $1 into the election, and if the market crashes during the election cycle, we end up making all the money above that. Or is it
we make about we have 150, so it's over 300,000 protection.
Yeah.
So we are.
That's the same kind of hedges I have. In fact, I think I like that hedge a lot. In fact, if UVXY gets a little bit lower, maybe we'll take a spread on it.
I did actually right around here. Yeah.
The problem is it goes way, way up and then it comes right back down. That's the problem with it when you have an actual spread versus having just long calls, which can pay off quite substantially.
Yeah, that's why I didn't want to write the puts, because if I'm wrong, my risk is still about $1.
Mm-hmm.
At the time I did it, it was paying a nice amount.
So how do you measure risk? That's a pretty good question. So
Well, like I said, it's more of a selection of the companies right now. We're looking at companies, they happen to be going up and more volatile than usual, but I looked at where they were at the low of the pandemic. I looked at where they were now, and I looked at how they did during the pandemic. So it is more of not worrying about where the market's trading them, but worrying about the company itself. So if I know sales are good and they're growing, for instance, Costco, first of all, it was absolutely ridiculous. If anybody did buy Costco after their earnings when they went down, it was the most ridiculous thing. They beat store comparisons by 11%. And remember, last year there was no COVID, and they still have 11% more sales in the stores now. Their online sales, their digital sales are up over 90%. They beat on earnings, even paying by 20 cents, even paying an extra, I think it's $16 million a week to employees for the $2 an hour that they're giving them for PPE wages and or COVID wages. So, I mean, it was just insane, but they're going to continue to do well. I'm looking at a few more stocks right now that are in that category. Lowe's, is still crushing it. Home Depot is too. I didn't buy Home Depot only because we had Lowe's, and it was almost like, two the same thing. UPS, they are charging an extra $3-4 a package in December to Amazon. And they blew out earnings, and they're doing well. And their CEO also has a history of buying back stock and doing well and increasing share price. So I look at all these factors more than I do, and also where it was during the low of the pandemic. But these are the factors that are more important, is how the company itself is, how the company's health is. I don't want a company that, it's low and, or it's high and it went low and it's doing well, it's relative to where it was, but there's nothing there, which means that company could go 50% lower again, which is why we don't have a lot of tech.
So like Macy's, right?
Yeah, well, I'm not buying Macy's, yeah. and that's why we wouldn't buy like Nikola or something
Macy's,
like that.
Doesn't like Macy's, yeah. Micron just took a hit because they got a poor report.
Yeah, I mean, I was shocked. We don't have it in either portfolio, but I was shocked to see GameStop pop up, but it was because the Chewy.com owner say he wants to, rival Amazon now in video games.
Yeah, good luck. Anyway, so Todd's asking about Cleveland Cliffs, which we talked about yesterday. They're buying Mattel. No, I'm sorry, they're not buying Mattel. They're buying Mattel's U.S. assets, which honestly, I don't even know how much money that's really worth. I guess it's probably written up somewhere. But the question was, he said, I mentioned yesterday it would increase the debt of CLF with the Mattel asset purchase. And he's saying that the purchase is actually cash and stock, but not debt. But okay, I said debt, but the point is they're putting out something. Whether they take on debt or whether they lower their cash position so that they have to take on debt in the future, and whether they dilute their shareholders right now so that you're always diluted and the earnings now spread over a wider pool, which doesn't mean they don't have the same impact they would have had they just purchased it with debt. I almost rather would have had them do a debt purchase and then use up my valuable stock, but of course that's how they made this transaction happen. I personally, like I said, I long-term like the idea. I think that they're right to buy more assets. I think that Mattel is getting out in an uncertain environment and they're giving up their assets on the cheap in a bad situation. Of course, you're going to take advantage of that. Why wouldn't they? Why wouldn't Cliffs want more stuff? But then, how do you feel about a situation like that, Doug, when they've just taken on a big chunk of new assets and stretched themselves?
It's not a company we'd be involved in the income fund.
So even though it's a basic U.S.-based steel company,
it's just the sector they're in.
Yeah. So basically, it's the same thing I said yesterday, except I said it basically because I just don't see them on the short term. I'm not a fan of what they're doing. It's an M&A. It's an acquisition, kind of an M&A. They're bringing in. They're acquiring the plant, the people. They've got to deal with a lot of stuff. Cliff is not such a huge company that they can absorb things easily. And they're stretching themselves. There's no question they're stretching themselves, even if they did have the cash to do it. So that means the next thing they do, they don't have the cash for and they have to borrow it one way or another. I don't think that's a reason to get out. I'm not saying I don't like them, but I don't consider it a reason to get in at this price. $650 is not really that cheap for them right now. It's a great company. I've picked CLF over and over again over the years, but it's not a compelling purchase, and certainly that asset purchase doesn't change my opinion very much. All right, so if we look at the financials for them, they're valued at $2.6 billion right now. They only had $2 billion in earnings. They only had $2 billion in earnings last year. So that's not really all that, I'm sorry, in income, not earnings, in income. And, good for like about $300 million in profits. They're running 15% profit margins. That was last year. This year, of course, I'm sure it's much worse. And year ago, EPS 105. This year, EPS is a loss, probably. And next year, they're barely going to make any money. So why would I be excited about this? And again, I don't think that's a bad thing. I don't mind them taking advantage of a situation. I don't mind them planning for the long-term future. I applaud companies for doing that sort of thing. But that doesn't mean that I want to be the short-term investor who pays for that while other people are abandoning the stock. Hovnanian is another one. Hovnanian is fantastic at taking advantage of downturns. It's not, I don't know if the analysts abandoned them or what, but there's not even any estimates on these guys. So that's not really something you can go by. Wow, there's no financials on them either. That's horrible. What's wrong with these guys? HOV. All right, so there's Hovnanian. Net income. What? What is this format? I'm confused. All right. Net income 42. What? Oh, it's a cash flow statement. That's why I thought this was the income statement. Like, what the hell is starting off with the income? So let's go back to regular. So here's what you can see on something like this. The earnings are pretty steady. 2 billion, 2 billion, 2 billion, up and down a little bit, but basically 2 billion in revenue you can count on. So what do they do out of that? Well, they lose some, make some, lose some, but every time they lose, it's a lot more than what they make. Make some, lose some. So this is not a good housing environment for these guys. They're not going to be cranking up the cash. And you have to really think hard about your long-term prospects when you're investing in companies like this. As you know, again, Hovnanian is one I was very excited about 10 years ago. Picked him a couple of times. I think last year, the year before, we picked him, and they did well for a while. But this is not a good cycle for them. You have to pick your spots. And we're talking about CLF now. So CLF, they've been on a downturn for one thing. 2 billion, the current business model, since they divested a bit, they're in the 2 billions. Now they're reinvesting, they divested, now they're reinvesting. And the income, though, at least they make some money. They made 143, 122, 360, 1 billion. So now they're all full of themselves. Last year, a bit less. This year's going to be a disaster with no money being made. Next year, no money being made. After that, I'm going to be a big fan again. But why do I want to be there now? When they're better, when they're out of the coma, give me a call. That's when I want to get invested in this thing. All right. And by the way, maybe it'll get away. Maybe they'll come around the corner faster than we thought. Maybe it'll take off like a banshee. So then we'll pick something else. I want to buy something when it's being given away. I want to buy something when it's a bargain that I can't possibly resist it. That's when I like to get into a stock, not just because I think it might do better in the future. All right, so we're going to wrap this up shortly. Doug, thank you so much for coming. Any closing commentary?
No. I mean, I'm curious to see what the market is tomorrow. I mean, it's fading right now very quickly, which I was actually I was just kind of hoping for.
Oh, shit. All right.
But this is window dressing day. So I have a feeling, usually last week of the month, they are going to pump up the market.
Oh, it is the last day of the month. That's right. That's why it's up so much.
Yeah, so it's usually, I take everything the last day with a grain of salt, and we see what happens in the first week of the month.
Yeah, I forgot it was the last day of the month. Last day of the quarter, for that matter.
Yeah.
So yeah, there's a good reason the market's up. It's a good day to talk about stimulus and bullshit the markets. So thank you for reminding me. Yeah, look at this. Holy crap. Wow. So they got their spike. Wow, look at gasoline too. Whoa, that's an incredible move in a couple of days. All right. Well, thanks, Doug. We really appreciate you coming on. And thanks. I'll talk to you later.
Okay, take care. Bye-bye.
Have a good day. All right. So now that we're alone, let's see what we're doing. No, that was good. I like that. That was a good quarterly report. We find out what's going on and YM. And you guys get an idea of how Doug and I make these decisions and what we did, how we figure out what we're going to trade. We have conversations just like that all the time. He likes that, I like that. Ultimately, it's his decision, though. He runs, that's his fund. He runs it, but he's off. If I have ideas, I tell him. I think something's good, something's bad, but they're his decisions to do it. Let's see. On the Dow, we've got 2788. On the S&P, we're at 3367. Don't forget 3350 was at 3350 was our shorting line, but just because it was doesn't mean it still is. Now it's 3360 for sure. Look at this nice line to short. If we get below it, so far, can I plus this? Yeah. See that? So far, look what we did. This is a very technical sell-off. You can tell, a very technical bounce. We bounced right off that resistance line. So we bounced right off the first resistance line. We stopped right at the other resistance line. So you can see this is just following the technical rules. That means robots are trading this, not people. There's no real sentiment change here. Look at this one. Up to the top, back down, up to the top, back down. These guys kind of all over the place, but coming back down here. Now, if these guys fail 1500, the other guys are all going to go below these red lines. So that's a good leading signal. If you see the Russell go below 1500, definitely you want to start shorting these guys. But I would say all these guys, just use the red line, 27,500. Oh, I'm sorry, 27,600, 3360, and 11,425 I would go for here. And well, no, I would say 11,420. So 11,420 on the NASDAQ. And so if you start losing those lines, then you want to start shorting those indexes, keep tight stops above. And by the way, when I say tight stops above, I mean that if any of the three get back above their lines, you get out. It doesn't matter which one you're in. Don't wait for yours to go above the line. Why should you take a loss? So in other words, if you picked the S&P at 3360 and you're down to 3350 or 55 and you made a few $100, but then the NASDAQ pops back up, you don't have to wait for the S&P to pop back up. You take your cue from the NASDAQ and get out and take your profit. If you see the other indexes starting back up, don't wait for yours to confirm that you're going to be screwed. Just take the money. There's nothing wrong with taking a small victory when you're trading. Oil, if it goes back below 40, the oil report had a nice draw in it though. So it's not a great bet. I wouldn't reflexively bet oil short. Gasoline's coming up fast. Natural gas is well, it's not that great really. This is mostly the rollover of the contract. Tesla's back at 430. Gold is rocking and rolling up and down over here. Gold, if it gets back over 1900, makes a wonderful bullish bet though. Now you can use that line for your stop. So that's one I wouldn't mind playing either. Todd says, CLF, thanks for the commentary. I like the long-term story. Yeah, it's a major investment cycle, but I think it's a little bit early to be counting on them to come out of it. That's all. I mean, I do love them long-term. I always like this. I like their whole business model and what they're doing. I think is very good. And that's where we are, guys. So everything's hunky-dory, basically. Long-term portfolio. Oh, that was a while ago. So let's see. It was up 98.9%. Let's see if we get to 100 on this rally. Dun, 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 dun. I hope it's going to refresh. Maybe not. We have that problem with this thing. I think it's not the computer's power options that does this. Wow, Dow's really coming down fast. Look at that. I guess we might need to use those shorts. Oh, seriously? That's taking way too long. Oh, there we go. Up 99. That's disappointing. All right. And how badly damaged is the short-term portfolio? That's the question. So this guy's just shy of $1 million, right? 994. And the short-term portfolio hopefully still has 400,000. Oh, barely. 406. So we're still at that 1.4 million though. That means, you know, the market just went up 500 points from yesterday, and we have the same 1.4 million we had yesterday. It just moved a little bit. Basically, $80,000 left the short-term portfolio and went into the long-term portfolio. That's balance. And by the way, that's funny. That's exactly what Bernie was saying. How could this be balanced? That's how it can be balanced. You have your longs, you have your shorts, and they balance out in a volatile market. The long positions themselves can be volatile. The short positions themselves can be volatile. It's our job to make sure the volatilities match up and that we're trading on an even keel. And that way, we only have to worry about collecting the cash from the premium exchange, from the premium depreciation as time moves on. And we know for sure that that premium will expire and will drop into our portfolios. That's the key. That short portfolio, that short premium we sell becomes profit. That profit becomes money we can distribute. Those distributions are something our people can count on because we're doing it all the time on a regular basis. But it requires watching, and it requires a good notion of a strongly balanced portfolio. That's what you have to have. You know, and Doug is very, very good at that stuff. He's very, very sharp and pays good attention to everything. Which is why we started doing this. We certainly experimented hard on the first fund that we did. That one had some losses at first. It's come back now. It's doing well now. It's adding nice. Like I said, I think he said it was up 10% last quarter, it's up basically about 30% in the last 3 months. So that's pretty freaking good. But this portfolio has only just started and it's doing phenomenally well, the income portfolio. And this is a result of the experiments that we did and the testing and the theories and so on and so forth to make sure we had something bulletproof. And now we can like hopefully do well with like setting up these long-term accounts. So it's only 1 quarter. So not a track record yet, just the first quarter, but it's going very well. And that's the key. We just have to be able to have a strategy that we can count on, prove it out for a year or so, and then we can start marketing it to a broader audience. So I think that's a good thing. But it's not that different from the long-term, short-term strategy, except I run the strategy. Like I said, I'm a long-term monthly person. I like my 2022 positions. I like my hedges to be even long-term. I don't like to mess around. I don't like to sit there and stare at the screen every day and keep making adjustments. That's not my thing. That's why I need somebody like Doug. I just don't have the patience for it, and I certainly don't want to be locked at the screen all day, which is basically what Doug does. He's always at the computer. He's always watching the market, and that's what you need though. If you want someone watching your money, you need them to actually watch your money, not just kind of do it as a part-time job. Anyway, so I think that's about it. I mean, I'm in a good mood. So I don't even want to talk about the virus. I don't want to talk about Trump. I don't want to talk about the election. It's just, it'll be what it'll be. One can only hope that things improve over the next 30 days, but it's going to be a very volatile 30 days. So be very careful. Make sure you do have hedges and just keep yourself balanced. I mean, that's pretty much the theme of what we were talking about. Be balanced, and it's easy to make adjustments, but you have to start by being balanced. You can't. Balance doesn't mean swinging wildly from one end to the other. Balance means stay in the middle. Don't swing for the fences. Stay in the middle, make your nice steady profits, and then it's easy to make adjustments. If you are trying to make big wins and you miss, you're off balance, and then something else puts you off balance, and that's how people screw up. But right now is the time, cashy, cautious, balance, because we don't know what the hell is going to happen in the next 30 days. It's going to be crazy. We don't know what's happening with the results of the back to school stuff with the virus. We don't know what's happening with the election. We don't know what's happening with Brexit. We're back to Brexit again. That's another disaster that's starting up again, which also may spike the dollar higher, which also may be bad for the market. So we have to watch a lot of things right now. So I do advise caution. I do advise being careful. The economy certainly is not gangbusters, but the market is still acting like it is.